All right, let's take a look at the biggest themes in the markets this year and get an outlook on what to track for the year ahead. We are joined by Nate Thooft, CIO and Senior Portfolio Manager at Manulife Investment Management. Nate, thanks as always for joining us. As we look ahead, what things from 2025 are we going to be bringing in to the new year?
I think the first thing about 2025 is that for 2026, we're looking for what is the next catalyst. This year, we had a number of drivers that ended up making the markets a bit better than I think a lot of expectations were early in the year. Notably, we saw tariff dynamics better than expected. We had some very significant concerns earlier in the year, and they ultimately ended up being better than expected, as in not as bad or as high. Two, we had a central bank that's been cutting across the globe, both in the United States, but also global central banks. And three, resilient growth. We've seen growth hold up pretty well, including the growth of AI. My concern is that looking into 2026 is the market is looking for what is the next catalyst, because these known catalysts are pretty much priced into the market. The market knows about central bank cutting. The market knows about AI spending. The market knows about the fact that tariffs aren't as high as they could have been earlier last year. So this year is going to be a bit more challenging, in my view, from the perspective of those drivers, because we're looking for new catalysts versus what we had as a positive throughout 2025.
Could inflation be it? I mean, the numbers we saw today, could that be the driver that kickstarts it?
We're actually more concerned about inflation in the opposite direction. Yes, I do think the base case is that inflation is in a reasonable zone. So the Fed will be okay with inflation in this 2.5% to low 3% number. So as long as it stays there, I think you still have a Fed that becomes very accommodative. And we would argue that the risk or the opportunity is the Fed actually might cut more than expected. So that could be a positive catalyst. Right now, the market is pricing in roughly 2 quarter-point cuts next year, where we think it's very likely we'll see 3 quarter-point cuts, if not potentially more, with the right makeup of the Fed, particularly after Powell is no longer chair of the Fed. So there is one catalyst there that we could actually see greater accommodation from central banks, particularly from the Fed, which would help risk assets.
And what would that makeup be with the Fed?
So no one knows, obviously. Obviously, we're going to get a new chair.
But what would you like to see, though? What would you like to see? Or what would you,
what we would like to
cuts?
see is that one of the existing candidates that's on the table actually gets it, because all of those candidates, in my view, are qualified for the job. Yes, we can all debate about the nuances of who might be better or worse, but they're qualified for the job. And I think that sets the standard that the Fed will maintain a level of independence, and they will be able to have articulate arguments. Even if they have arguments that are more for more cuts, it will still be in the vein of what the Fed should be doing and focused on when it comes to inflation, when it comes to growth, when it comes to jobs. And so I am still of the view that the Fed will come across as an independent agency. They won't be outright biased by broader dynamics. And the candidates that are in play for the chair are okay. The bigger question, though, is who will be the other members of the Fed and how dovish will they be? And will the Fed actually start arguing about a lower neutral rate, which will help justify further cuts beyond what currently is expected by the market?
And how much of a factor do you feel the Trump factor is when it comes to the Fed? We've heard him call and call and call again for cuts. Is that a big pressure, or are they going to maintain that separation?
The administration is allowed to have a view on this. Now, do I think the Fed is just going to take that view and implement it? No, I don't. I do strongly believe, and the candidates that are on the table today for the chairmanship will maintain a level of autonomy, and they will focus on the drivers that I previously mentioned. So while the administration is not going to be shy about vocalizing their views, I don't think you're going to have a Fed that's going to be overly swayed and basically follow the direction of administration. They have a job, and the job is very clear as it pertains to what they should be focused on. That does still afford them, though, some nuance around what do they want to focus on more. If the Fed focuses more on growth concerns and job concerns, which are a bit more challenging, that will allow them to do more cuts. If they're more focused on inflation, however, that's the opposite effect. It will be fewer cuts. And I think we're in a position where the Fed will basically argue that inflation's in an okay spot. It might be a bit high, but we can point to transitory type of effects such as tariffs driving that. Shelter inflation is certainly coming down as an offset, and they'll be able to afford them to focus on the things that are more problematic, such as the slowing job dynamics and growth not being as strong as it could be.
Okay, with AI, we've seen some rotation. Do you see that continuing into the new year?
One of the things that I think is going to be a positive theme for next year is while we've had some very strong performance for certain momentum names this year, and arguably in some cases lower quality and lower earnings type of names, except for the Meg 7, which are obviously great performers and great earners. But I do think we can have an opportunity to see broader participation in the market next year. And I think there'll be a much greater appreciation for quality next year. This year, in 2025, quality as a factor and as a driver of stock performance has been very, very weak. And so high quality companies have actually underperformed, and consistent earnings, high free cash flow companies have underperformed. I think next year we'll start to see more appreciation for those types of companies, which is allowing us to gravitate a bit more to areas like healthcare as an example, stick with some of the high quality tech names, look for high quality opportunities in the consumer and industrial space. So I do think there's an opportunity for broader participation rather than just relying on the momentum names that have driven us in 2025.
Okay, we're going to have to wrap it up there. I wanted to get into fixed income, but we are out of time. Nate, thanks as always for joining us.
Thanks for having me.
And Nate Thooft is CIO and Senior Portfolio Manager at Manulife Investment Management.